Now we will discuss how to add new partners, and next we'll discuss how to withdraw partners. However, in this first slide, this first topic, it will be a combination of the two because we're going to remove one partner and add a new one in at the same time. So it kind of covers both topics for a moment. When the makeup of a partnership changes, that is, the owners change, the existing partnership is dissolved and a new one is formed. Like I said, there are multiple ways to admit a new partner to the business. The first way we'll discuss is by replacing an old partner with the new one. The cash that's paid will go directly to the old partner that's leaving. No cash is going to be passed through the business. What the business is going to do is remove the capital account of the partner that's leaving and replace it with the capital account of the partner that's coming in. The journal entry will look like this. There'll be two capital accounts, one's a debit, one's a credit. The partner that's leaving, their capital account will be debited for the amount that is in that account, basically removing it and zeroing it out so that partner is no longer on the books. The capital account that gets the credit will be the new partner for the amount that's being replaced with the old partner. For example, if partner A is being removed and they had a $100,000 capital, we'll add partner B with that $100,000 capital account. Let's do a practice problem with this. This is the next one on your classwork, number 3. The partners in Wheels and the Legman have agreed that partner Steve Smith may sell his $100,000 equity in the partnership to Roger Smith, for which Roger will pay Steve $85,000. Prepare the journal entry. In this case, Steve Smith is getting out of the business and Roger Smith is replacing him. Roger is getting a $100,000 equity investment in the business, but is only paying $85,000 for it. Like I said, the cash does not matter in this specific type of scenario because the business is only going to replace one account with the other. Steve is getting the cash here. Steve is obviously getting less than what he had invested in the business. He is taking a loss, but that happens sometimes, and sometimes it's in the opposite direction. But in this case, Steve is taking a loss. Maybe he really needs money or really wants out of the partnership, but he's willing to take a loss. We don't care about that. That won't affect our journal entry. What we need to do is remove one partner, the partner that's leaving, which would be Steve Smith, S. Smith Capital. His capital or equity in the business was $100,000. That is what we are removing. The second entry would be the new partner that's being admitted to the business, which is Roger Smith. We will make a new account, R. Smith Capital, to put Roger on the books, and he is just taking over for Steve Smith for that $100,000. Once again, the $85,000 is irrelevant in this scenario. Another way to add a new partner to the business would be by them investing assets into the partnership. In this case, the consideration that the partner pays will go on the company books. The new assets will increase whatever the new partner will give to the business. And after that, their capital account will also increase. This part gets a little tricky. I'd say this is one of the more difficult parts of this chapter. We need to calculate the value of the investment. If they just give a straight $100,000, we don't put them on the books for their capital account for a straight $100,000. We have to see what percentage of the business we're going to give them and what the value of that money brings and what their capital account should be based off of that. Like I said, it gets a little confusing. We have to follow this formula. We will take the investment that the new partner is giving, whatever the value of that is, and add it to the capital of all the other partners. We will take that and multiply it by the interest percent that we're giving that partner. What percentage of the business are they getting by giving us this investment? When you do that, that would be the value of the investment. From there, we have to see if it's going to be a bonus or no bonus. Whatever that new partner is giving their investment, if it equals the value of their investment, there's no bonus. They are giving exactly what they should be giving in order for that percentage, and they get the same percent as everyone else. It's kind of like everything's equal. I'm giving 100,000 and the value of that investment is $100,000. Now, if the investment that they're giving is more than the value of the investment, like I'm giving you 100,000, but my capital is only going to be 80,000, that's because there's going to be a bonus to the old partners. The old partners will get a little bit of extra, while the new partner coming in maybe is losing a little bit. On the other hand, their new investment could be less than the value. I always say this is more like a Shark Tank scenario where they'll bring on the sharks as an investor and they give them a better deal than what other investors would be getting because they bring something extra to the table. In this case, there's a bonus to the new partners. Maybe they're giving $100,000 investment, but they're getting $120,000 worth of capital. They're getting more out of it in the end. We're going to practice each one of these scenarios next. This is your classwork number 4. We have Cartman Land, a partnership that has total partners equity of 510,000, which is made up of Cartman's capital of 400,000 and Marcia's capital of 110,000. So there's 2 partners right now. The partners share net income and loss in a ratio of 80% to Cartman and 20% to Marsh. On November 1st, Broflovsky is admitted to the partnership and given a 15% interest in equity and a 15% share in any income and loss. Basically, Broflovsky will be a 15% partner. Prepare the journal entries to record the admission of Broflovsky under the following assumptions. In Part A, record the admission of Broflovsky with an investment of $90,000. In this case, with a $90,000 investment, we have to see if there's no bonus, a bonus to the old partners, or a bonus to the new partners. We have to follow that formula that was shown on the last slide. I copied over some of the information from the problem here, along with the formula to follow. The new investment by Broflovsky is $90,000. We're going to add that to the previous capital of the $510,000. When we total that up, we get $600,000. We will multiply that by the interest percentage. That's the amount we're giving the new partner, which is a 15% interest. 600,000 times 15% equals 90,000. Broflovsky is giving 90,000, and the value of that investment, what it's worth for the capital account, is 90,000. The new investment, 90,000. The value of the new investment, also 90,000. Since it equals, there's no bonus to a new partner or to an old partner. The capital that Broflovsky is getting is the exact same as the investment he's giving. The journal entry for this is actually pretty easy to do. The company is getting the cash, it's getting the asset, therefore cash will be debited by 90,000 because that's how much the business is getting. We then also need to add the new partner onto the books. We have to put Broflovsky's capital account down. And because the investment is worth the amount he's giving, the capital is also 90,000. We're going to be going over the other scenarios next where they don't equal and that there are bonuses. For instance, in Part B, record the admission of Broflovsky with an investment of 120,000. Everything else is the same. We're going to use the same formula to figure this one out. The new investment this time is 120,000 instead of 90,000. We're still going to add that to the previous capital of 510,000, which gives us a total of 630,000. multiply this by the interest percent, which is 15%, gives us a total of 94,500. The new investment is 120,000. The value of that investment, the amount of capital that Broflovski is getting, is 94,500. In this case, his investment is more than the value of the investment, meaning that there's a bonus to the old partners. This extra amount that Broflovski is giving is going to end up going to the old partners and increasing their capital account because they're getting bonuses with this extra money. I'll show you how to do the journal entry for this. The journal entry starts the same way we did it in part A. First, we input the cash of $120,000 that the business is getting. We're going to add Broflovski's capital account to the books, but it's not going to be for 120,000. It's going to be for the value of the investment, which we calculated to be 94,500. The cash is higher than what the investment is. As I just said, this extra amount that Broflovski is giving in cash is going to be a bonus to the old partners. Their capital accounts are going to increase. I'm going to add the old partners on here, Cartman and Marsh Capital. Now they increase the same way that they split up income. Currently, Cartman gets 80%, while Marsh gets 20%. The extra money that was given was $25,500. There was cash of $120,000 given, but only a $94,500 investment was put on the books. When you subtract the two amounts, you get $25,500. This is the amount of the bonus that's going to the old partners. Now we'll split this amount up, 80% to Cartman and 20% to Marsh. When you multiply 25,500 times 80%, you get 20,400. When you multiply 25,500 by 20%, you get $5,100. So in this scenario, Broflovski was put on the books for 94,500, but he had to give 120,000. That extra 25,500 ended up going to Cartman and to Marsh. Both their capital accounts have increased. Let's see the last scenario for this in part C. Same information, except for in this case, Broflovski is giving an investment of $80,000. In this situation, the new investment is $80,000. Add that to the previous capital of $510,000, and the total is $590,000. Multiply this by 15%, and we get $88,500. The new investment was $80,000, but the value of that investment is $88,500. In this case, the value of the new investment is greater than the investment itself. Broflovski only has to give $80,000, but he will have a capital account of $88,500. This is the bonus to the new partner. Where does this extra capital come from? It gets deducted from the previous owners. The other two partners will lose this extra money and give this bonus to the new partner. Like I said, this would be a Shark Tank scenario where we're getting some very great investors, someone we really want on. Maybe they have a lot of experience and we want to give up some of our capital to give them a better deal because of how valuable having them as a partner is. The journal entry is pretty similar to part B. First, we enter the cash. How much cash is Broflovski giving the business? $80,000. Next, we have to put Broflovski's capital account on the books for the value of his investment, which we calculated to be $88,500. Remember, in this case, the cash amount is less than the capital. In part B, the old owners got extra money. In this case, they'll be losing it. Instead of doing a credit to the old owners, we're going to be doing a debit to the old owners. Their capital will be going down. We have Cartman and Marsh as the old owners. I'm putting them on the books as a debit Like I said, it will reduce their capital. To figure out the amount, it's the same thing we did in Part B. Find the difference between the value of the investment and the cash amount, which would be $8,500. We split that up the same way, where it'll be 80% to Cartman and 20% to Marsh. 8,500 times 80% would be 6,800. 8,500 times 20% would be $1,700. That is what Cartman and Marsh are both losing in order to have Broflovski as an investor.